This is Scott Becker with the Becker Private Equity and Business Minute podcast. Here are 7 of the stories that we're following today, and thank you for listening. First, the markets are pointing down today significantly. Another tough day in the markets, as it's expected that the Fed is going to have to be more aggressive about raising rates as inflation still stays very much afoot. And so that's what's driving markets down. A couple of Wall Street Journal articles, other articles, Dow futures slump over 200 points amid rising bond yields and geopolitical tensions. Stock futures fall on interest rate worries. So again, a lot of concern the Fed's going to keep on raising rates. Those are the Wall Street Journal Yahoo Finance this morning. The markets were also down on Friday. Year to date, the markets remain up, though they're going down today a little bit. But the Nasdaq still about 13.5% year to date. The Dow about 2%. The S&P about 6.5% or so. Next, the 10-year Treasury yield is close to almost 3.9% or so. It's highest in some time. The 1-year Treasury is above 5%. Again, these all have impacts on how people view the stock market, and also the continuation of Fed policy impacts the stock market. Fourth, we've got Bitcoin up 50% year to date. I don't think a lot of people saw that coming. It's around $25,000 now. Fifth, a very dangerous sign, just because there's so much debt out there in the world on office buildings. Office buildings are starting to default on bank loans. Here, the movement towards remote work and hybrid work has less people coming back to offices, together with higher interest rates, is causing lots of stress on the commercial real estate industry, particularly in the office space sector. If you'll remember, we talked about yesterday car loans. People started to default on car loans. And so what you're starting to see is there are very real impacts to these increased interest rates. There's also real impacts, of course, to the fact that office space has not come back like at least landlords were hoping to see. 6, there's an article in the Wall Street Journal today about what we think of as corporate virtue signaling, where, and this is not the ESG type of corporate virtue signaling. This is the kind where corporations, to please Wall Street, say they're doing layoffs. And what you're seeing is many places announce layoffs and then are nearly cutting headcount as much as they said they would announce. And it's sort of they try and pitch to the street that we're going to get more careful about profitability. And I'm not saying they should do more layoffs, but I am saying there's some disingenuousness in terms of saying they're doing layoffs, but not really doing them. Finally, 7th, a new kind of Treasury default risk, and people are starting to get a little more cautious about holding Treasuries, and this is a little scary for all of us. The concept being the short-term Treasury risk as the Congress sort of figures out the debt ceiling, which we're already bumping up to. And then the longer-term default risk is that the U.S. just takes on too much debt as a country. People are less worried about that rate at the moment. They are worried about short-term, whether some payments get slowed and so forth, which would be a debacle for the U.S. Long-term debt numbers, just aggregate debt numbers, the total amount of debt taken on, is a real disaster for the U.S. economy. But 2 types of debt risks that are coming on, and again, more articles being written about this discussion this morning, and Reuters analysis, looming U.S. default risk prompts investors to cut some debt exposure. And it's sort of fascinating to see that as to what's going on here, both with the game of chicken being played at Congress, plus long-term, the amount of debt being taken on. Thank you for listening to the Becker Private Equity and Business Minute podcast. Thank you very much, and thank you to Jeremy Core, wonderful leader at Executive Podcast Solutions. Thank you very much.